Today I'm talking about the shadow ledger, the company's house versus the family courts. Welcome to Silent Screams, Loud Strength. I'm your host, Samantha, a survivor of domestic abuse and recovering from trauma. So, let's dive into this. The fiction of insolvency. It is a fiction. It is not a discussion. This is not a discussion. This is a forensic examination. Today we expose what we call the shadow ledger, the concealed financial architecture operating underneath family court proceedings. At the center of every financial remedy case lies Form E, a document governed by the duty of full and frank disclosure. That duty is not optional. It is a legal obligation reinforced by the Marital Causes Act 1973, the Family Procedure Rule 2010, and established case law, including Legacy versus Jenkins 1985. Failure to disclose is not a technical breach, it is fraud upon the court. And yet, we repeatedly see respondents representing themselves as insolvent, financially distressed, without liquidity, while simultaneously funding high-value legal teams, corporate operations, lifestyle expenditures, inconsistency with declared income. This is the insolvent charade. Because while the family court is represented with a narrative, there exists another record, a statutory record, I may add, filed under legal obligations of public, immutable company's house. This is a shadow ledger. The alter ego, company, and the failure to pierce. Under Section 25 of the Marital Causes Act 1973, the court is required to consider all the financial resources, all, with each of these parties or is likely to have in the foreseeable future. This includes corporate interests. It includes directorships, shareholdings, control structures, undistributed profits, intercompany loans. Yet in practice, a systematic failure emerges. The court often treats the company as a separate legal entity when assessing liability, but a personal extension when assessing lifestyle. This contradiction is not neutral, it is exploited. The mechanism is simple. Marital assets are transferred or loaned into a private company. Income is artificially suppressed through director salary manipulation. Corporate funds absorb personal expenditure. Retained earnings accumulate outside of the marital pot. The individual appears impecunious The company appears healthy. This is not legitimate structuring. This is economic abuse through corporate forms. The legal doctrine of piercing the corporate veil, clarified by Prest versus Petrodel Resources Ltd in 2013, provides that where a company is used to conceal the true beneficial ownership of assets, the court may look beyond the corporate structure. The issue is not absence of law, it is absence of application. The evidence gap, public record versus sworn statements. Under the Civil Evidence Act, 1995, documentary evidence is admissible and carries probative weight. Companies' house filings include annual accounts, confirmation statements, registers of persons of significant control, director filings. These are not opinions, they are statutory declarations made under legal duty. And yet, the family court will routinely observe a hierarchy of inversions. A Form E narrative is accepted at face value. A public corporate record is ignored or under-examined. This is not evidential neutrality, it is procedural imbalance. The consequence is predictable. Corporate structures remain unscrutinized, financial asymmetry is entrenched, disclosure becomes performative rather than substantive. Where a survivor or where survivors attempt to bridge this evidential gap themselves, they are frequently characterized as obsessive, difficult, vexatious. This raises a deeper concern. The intersection with the findings of the Macpherson Report 1999, especially the concept of institutional bias, where a legitimate, particularly a woman of color, presents structured financial analysis, her credibility is not enhanced, it is diminished. The prejudice and paradox and professional duties. Let us be precise here, okay? And knowingly false Form E engages contempt of court, potential perjury implications under Perjury Act 1911. The obligation is clear. Disclosures must complete, accurate, and honest. Yet, enforcement is rare. This creates what we define as the perjury paradox. The duty is absolute, the consequence is negligible. We must then examine the role of the legal representatives under the bar standards and the handbook. Core duties include CD1, actually, duty to the court, the administration of justice. CD3 is duty to act with honesty and integrity. And CD3 is not to mislead the court. Where counsel is presented with contradicting company's house filings, evidence of disclosure assets, indicators of artificial income suppression, and continues to advance a position of insolvency, there is a question of professional compliance. This is not about adversarial advocacy. It is about the boundary between representing a client, facilitating a misrepresentation before the court, the human cost, economic abuse in practice. So this is not abstract. It is not theoretical. This is a lived reality. The outcome of financial misrepresentation in family court is not confined to spreadsheets. It is a result of loss of housing, financial destabilization, prolonged litigation, psychological harm. While one party presents as without means, as assets are preserved elsewhere, shielded, structured, obscured, the survivor is left navigating reduced settlements or no settlement at all, increased legal costs, structural disadvantage. This is economic abuse executed through the legal process. The call for forensic justice. The response must be structural. Mandatory forensic accounting triggers where corporate structures exist. Courts should require independent forensic review, cross-referencing of companies' house data, analysis of directors' remuneration versus retained earnings. Evidential alignment protocols, Form E disclosures, must be tested against public filings, banking records, corporate benefits extractions. Professional accountability, regulator bodies must actively assess all of this, all these misleading submissions, failure to disclose material contradictions. Judicial training, judges must be equipped to identify corporate shieldings mechanisms, artificial income suppression, economic abuse through financial structuring. The shadow ledger exists whether it is examined or not. The question is not whether the evidence is there. The question is whether the system is prepared to look at it. Because when corporate records contradict sworn disclosures, the issue is no longer complicity, it is accountability. And accountability is not operational.